Okay, well, let's have a look at another example. Now, this is a little bit trickier, and it's for those people who go short on stocks. And by short, I mean sell stocks first, or CFDs, or spread bets, whatever it is. They sell them first in the expectation that the price will fall and they'll buy them back cheaply later. In other words, they expect the market to fall. Now, how do we use the formula in a situation such as that? Now, I know it sounds all a bit complicated and messy, and if you're not into short trading, then don't worry, you can ignore this bit. But let's look at it. What if we're looking at XYZ stock, and we expect it to fall, and so we want to go short, i.e. sell and expect to buy it later more cheaply as it falls? Well, if you did not know where to put the stop loss, you can use this formula. Now, here what we're talking about is, okay, where do I put the stop loss? So we're using the formula and turning it around and manipulating it in one way or another to try and get to the answers that we need to find for our trading. What happens with this formula as we go forward is X, so I'll put it in, P, I minus E times R divided by I. I know it looks really complicated and messy, but it's actually quite simple. Let's work it out. X is what we want to know. Where do we put the stop loss? At what price point is the stop loss? P is the entry price on the trade, whatever that is. Maybe it's 100 pence or whatever. I is the investment amount. That's where you know how much money you're going to invest. E is the portfolio equity. That's the total amount of capital that you have to trade with. R is the maximum risk percentage per trade. That might be 1% or whatever. So E times R gives you amount of money. I equals the investment amount. So you can see how one's taken over from the other. Multiply that by the entry price and divide it by the investment amount. Ugh, I know it looks messy and complicated. Print out this little diagram, print out this thing. But I assure you, when you do the maths on it and work it out, it actually gives you a good idea of where to put a stop loss when you put the figures in there, based upon the calculations that we did at the back end of the other example when you're going long. And what that means is that we are therefore able to get to a very systematic, very professional idea of where to stop, where to enter, and so forth. Okay, if we take this forward a step, since we're shorting, let's say, with $10,000, I, the number I in the previous thing is negative because we're going short. The above formula tells us the stop price on the short sale is $48. And the reason I said that is because if we look at what we've done previously, flicking through the charts there, if we look at what we've done at the end of the previous example, where what we've done is we've taken a formula to work out how much we're going to be trading with. Remember when we did it here, we did it in a slightly different way? Well, just having reminded you of that, what we're looking to do here is what we're saying is we're going to short with $10,000. That's the figure we want to take here. And then the above formula, as I said, will tell us where we are. Predetermined stop is what we wanted. Entry price on the trade, investment amount, portfolio equity, percentage of risk per trade. Okay, what does this mean? In the above examples, we used E. That is an alternative way, that's equity, by the way, the total capital that we have. It's £100,000 or $100,000, doesn't matter which. An alternative way to measure E is one used by trading legend Ed Seykota. And he uses core equity. In other words, instead of working out what's my total equity, what's the total amount of capital I have, £100,000, I only want to lose, say, 1% of that. What he says is, well, it's not 100. How do you know what's £100,000? It's not necessarily cash sitting in a bank. What he does is he takes the value of the portfolio if all the open positions lost the amount of value that they have at risk. So you say, well, what if each one of them lost the most they could lose before my stop losses kicked in? And that means if you had 5 positions, each of £100,000 each, and let's say the most they could lose was 10,000, then you wouldn't say you've got 500,000. You would say you've got 450,000 as E. That's your core equity. It's the amount after you've lost all that you could lose. That's your core equity. The value at risk is found by multiplying the number of shares by the difference between the current price and the stop loss price, obviously. That's what tells us how much we could lose. If the current price is 100, the stop loss price is 90, then the most that we can lose is 10 pence per share, and if it's 1,000 shares, then it's 1,000 times 10 pence. That tells us how much money we could lose. We knock that off what the current value of how much money we've got to get us to our core equity. In other words, we're taking a smaller figure for how much money we're trading with, so that minimizes our risk even further. It's not 1% of the amount of money we have today, it's 1% of the amount of money we could have if we had all our losses happen simultaneously. So it's just a safer way of doing it. And what do? Well, I'm a little bit more cautious in the sense that whilst I agree with what Ed says, I also am a bit more pragmatic in that I will do a rough and ready calculation too. Now, if in the previous example ABC moved not from 100, moved from $100 to $120, then you should not leave your stop loss at $95, obviously. Otherwise, your actual maximum loss would be $25 per share, or 10,000, which is not 2%, but 9% of your portfolio. The reason I say that is because some people forget that, of course, you don't just wait until the stop loss gets hit. You can get out earlier, and if you're in profit, you can move up higher as well. Never move a stop loss in the opposite direction. In other words, as the price moves against you, don't keep on moving the stop loss lower. A stop loss is there for a reason, to stop your loss. You've got to hit it and take it, as it were. Now, this bit is an FYI. Some people use this formula. It's a very technical one. I mean, it's not complicated, but it's technical in the sense that it was originated by a chap called Kelly in Bell Labs in the US, the telecommunications company. And not that he was a gambler. He was actually a technician, an engineer, and he was trying to solve an electrical problem. But we've tried to work this out in what happened was the gamblers took it then to casino, how much money they should bet on each hand of cards. And then the traders took it on board as well. The issue is, what percentage of money should be put into each trade? So it's the same question as before. And the way you work this out, apparently, according to this, is W minus 1 minus W over R. In other words, W is the historical winning percentage of your trading system. R is the historical average win-loss ratio. So if you win 7 times out of 10, then the win-loss ratio is 7 over 3. Yeah? Historical winning percentage of your trading system might be, well, you win 70% of the time. The optimal amount of money you should put on each trade so that you maximize your returns is according to this formula, according to Kelly. Now, actually, this formula does lead to some inherent risks. It can make swings in your equity quite volatile. But I just wanted to raise it. It's not one I tend to use, but it's actually one which is worth looking at. So let's say your system is right 6 times out of 10. So W is 0.6, R is 1.5, i.e. 6 over 4, and the Kelly percentage is 13.3%. In other words, you should put 13.3% of your money into a particular trade. It's not a 13.3% stop loss. It's how much money you should put onto any one trade, is what it says. What does it say about stop losses? Well, it doesn't. Remember what it's talking about. It's talking about win-loss ratios and what percentage of wins you get. And it's assuming that you get a positive return overall. And it's saying optimally you should put that. What the system also is saying is if you put more money than that, then it won't grow as quickly as it could have done. If you put less in, it won't grow as quickly as it could have done. That's the optimal amount according to this formula. Now, slight change of tact in the next chapter. We're going to be talking a little bit away from the heavy maths, but you might want to review that whole chapter that we've gone through because I know it was quite heavy-duty work. So do have a look at it again.